leads our cloud accounting practice, and she will give you some guidance on the efficiencies to be gained by setting your books and records online or on a cloud platform. We will have time at the end for questions. So if you do have questions, please include them in the Q&A function, which is at the bottom right portion of your screen, and we will try to answer as many as we can. Please appreciate the legislation is new and there are still some clarification points, so please consult with your individual advisors as appropriate. So if we can go to the next slide. So what we're going to cover today are four main areas. Vanita will walk us through the legislation that has recently been enacted on October 1st and give you an indication of what the advantages of incorporation are. I will then go through some of the structuring components for a PREC, especially if you're using some of the after-tax cash in the companies to invest in real estate. And then Mickey and Melanie will go through the accounting and cloud implications of setting up a real estate business, let's call it, online. And then finally, we'll go through how we can help in terms of the services we will provide. So I'll pass it over to Vanita, who'll kick us off. Vanita?
Thanks, John. Hi, everyone. So as you're all aware, personal real estate corporations are now a reality in Ontario. In other words, you as a real estate professional are now able to incorporate and earn your commission income for your corporation. This opened the door to huge opportunities for you that we will cover throughout this presentation. Although the legislation was approved and enacted on October 1st, 2020, as John mentioned, we are still waiting for some clarity and detailed guidance from OREA and RICO. So we'll have to stay tuned to see what additional guidance they do hopefully release soon. Next slide. So now I'm going to go through some of the attributes that your corporation should have to qualify as a PREC. One of the most important criteria is that the controlling individual, which is in this case the licensed broker or salesperson, is the only person who is allowed to own voting shares of the PREC. They are also the only person that is allowed to be the director or an officer of the corporation. In other words, the legislation does not allow any other person beside the registered broker or salesperson to control the PREC. Family members can own shares of the PREC, but they can only be non-voting shares. Family members are defined in the legislation as being spouses, parents, or children of the registered broker or salesperson. Non-voting shares can also be owned by one or two individuals as trustees for minor children of the registered broker or salesperson. Another important criteria is that the PREC itself is not required to register with RICO if it meets certain conditions. I will go in more detail. I'll go over in more detail over some of the conditions on the next slide. Finally, the registered broker is required to notify RICO of the legal name and address that they had chosen for their PREC. And a written confirmation should be received that the PREC has met all the conditions to be exempt from registration before any remuneration can be paid by the brokerage to the PREC. Next slide. As I mentioned on the previous slide, a PREC does not need to register if it meets certain conditions. So some of these conditions are as follows. First, the registered broker must be employed by a brokerage. Employed here means that the brokerage can appoint or authorize the broker to trade, to carry out the business of trading in real estate. The definition of employee here also includes an independent contractor relationship, which I can expand further on the next slide. Secondly, the PREC itself cannot carry on the business of trading real estate, but is only limited to providing the services of a realtor to the brokerage. What does that mean is that you as a realtor can trade in real estate, not your PREC. Your PREC is not able to advertise a trade in real estate or directly receive compensation from trading in real estate. The third criteria is that the PREC itself cannot act as a brokerage. It cannot accept or receive remuneration from trading in real estate by any other person other than the brokerage. The fourth criteria is that the PREC itself cannot hold any money or property from trading in real estate on behalf of client or customers. That means that the PREC cannot maintain any trust account to hold a deposit from client or customers. Lastly, there need to be a written agreement between the three parties, that is, the controlling individual, that is a registered broker or salesperson, the PREC, and the brokerage governing the relationship between these three parties. If the PREC meets all of the above conditions, they will be exempt from registration with RICO. Next slide. As discussed in the previous slide, one of the requirements of the PREC is that the controlling individual, that is the licensed broker or salesperson, must be employed by the brokerage. One of the potential risks that we see with this requirement is that Canada Revenue Agency, that is CRA, might argue that the PREC is carrying on the business, a personal service business, where the individual is an employee. Independent contractors are exempt from the PSB rules. Under the Income Tax Act, there are rules that penalize situations where the individual incorporated corporation to receive what would otherwise be received as employment income, which is what CRA calls PSBs. What are PSBs? PSB exists when an individual performs a service. The individual here would be the licensed broker. Perform a service for an entity here, the brokerage, through a corporation, in this case it's a PREC, that he or she owns, and is reasonable to conclude that this individual is working in the capacity of an employee for the brokerage. So why are PSBs bad? The consequence of having a PREC being deemed to be a PSB is that the realtor will not be able to claim the small business deduction, as the income earned in the corporation is not going to be deemed to be active business income. The PREC will then be subject to a corporate tax rate of 44.5% instead of the 12.2% small business rate, which essentially eliminate all the benefit which comes with incorporation, that is the income tax deferral opportunity. Additionally, the PREC will also be limited with respect to what expenses it can deduct, as the individual is deemed to be earning employment income. It is therefore important that you work with your legal and tax advisor to ensure you, as a licensed broker or salesperson, qualify as an independent contractor as opposed to an employee of the brokerage, in order to ensure that your PREC is not perceived to be a personal service business. Next slide. So what is a PREC and what does it mean to be incorporated? On the left side structure represent how most of you are now carrying your real estate practice, that is as a sole proprietor. Under the new legislation, you will now own shares in your corporation, that is in your PREC, and carry out your real estate business through your corporation. All your future income that you earn will be through your corporation, which is basically represented in that structure on the right side of the slide deck. Next slide. So why would you want to incorporate? What are the benefits with incorporation? I'll go for each of these advantages in more detail, but in a nutshell, you will be able to benefit from limitation of liability, income tax deferral opportunities, have access to capital gain exemptions, have flexibility with Canada pension plan, as well as have opportunities to income split, look for retirement and estate planning opportunities. Next slide. As a sole proprietor, you're personally liable for the debts and risks of your business. Incorporating can help mitigate the risk of having your personal assets exposed to creditors, as your personal risk would be only limited to what you have invested in the corporation. However, it is important to remember, similar to other professional corporations, a PREC will not limit your professional liability as a realtor. You would still be held jointly responsible and liable with the corporation if there are any professional liability claims or unethical behavior against you or your PREC. Next slide. The most important and known benefit of incorporating is income tax deferral opportunity. Incorporation provides you with the ability to pay less taxes now and defer the taxes when your income are lower, for example, when you retire. For instance, if you are in a high tax bracket, your marginal personal tax rate is at least 53.5%. However, if you earn your income for your corporation, And any income up to 500K will be subject to the 12.2% small business rate. And any income above 500K will be taxed as a 26.5% rate. As you can see, either of these rates are much lower than the personal tax rates, which provide for significant tax deferral opportunities on an annual basis. Next slide. So as you can see on this slide, as a sole proprietor, which is the left side of the structure, if you don't need all your income to fund your personal lifestyle, your earnings are still being taxed as you earn it. But instead, if you earn this income now in your corporation and the funds are not withdrawn, your earnings will be taxed at the small business rate, which provides for significant tax deferral. It is, however, important to remember that if you do decide to withdraw the funds out of your corporation, either by way of salary or dividend, you would still be subject to the same high personal tax rate as if you earned that income personally. So to the extent that you can leave the funds in the corporation, there's huge tax saving opportunities there. On the next slide, I'm going to run through a numerical scenario to illustrate how this tax deferral works. Next slide. So let's take Justin, who is a realtor in Ontario. Let's say he earned an average annual income after expenses of $300K, and he needs around $100,000 to fund his personal living expenses. Justin is interested in investing in rental properties with any extra cash he has available. So how can incorporating help Justin achieve his objective? Next slide. So on this slide, you can see that if Justin incorporate and earn the $300K in his corporation, he will be subject to corporate taxes of around $36,000. After paying himself a dividend of $126K and funding his personal taxes, he will be left with cash of around $136,000 to reinvest at the corporate level. If instead he earns this $300K personally, he will have to pay personal taxes of around $121,000. He will still have to pay for his CPP remittances, and after funding his personal expenses, he will be left with cash of only $72,000 to reinvest at the personal level. So as you can see, incorporating allowed Justin to benefit from a tax deferral and left him with extra cash of almost $64,000, which he can now use to reinvest in rental properties. Next slide. Another benefit that you can enjoy with the incorporation is that you can get access to capital gain exemption. You may or may not know, but capital gain exemption is actually indexed every year for inflation. So for 2020, the capital gain exemption is around $883,384. So if down the road you're looking to retire or maybe sell your practice, the first $883,000 of your proceed would be tax exempt. That is, will not be subject to capital gain rates. However, if you do decide to sell your business personally, the tax on that could be almost $230,000. Which, again, if you do sell it for your corporation, you get access to huge tax savings. This benefit, however, is on the assumption that the realtor carries brand value for this capital gain exemption to be valuable. The PREC is not allowed to trade in real estate other than providing services of the realtor to the brokerage. So likely that PREC may not increase its value unless the realtor has generated significant internal goodwill. Next slide. Incorporation also allows for flexibility when it comes to how you can get remunerated. That is, you can decide whether you want to pay yourself a salary or dividend for your PREC. As a self-employed, you're required to remit CPP contribution for both the employee and employer portion. For 2020, this was around $5,800. However, if you do incorporate, you have the choice of being remunerated either with salary as dividend, as I mentioned earlier. If you want to pay yourself a salary, you will still be required to remit CPP, but if you choose to pay yourself a dividend, in this case, no CPP contribution would be required, which leaves you with more cash in your pocket. Next slide. However, you might want to be cognizant with the limitation with the dividend strategy. There are some limitation on personal tax deduction available to you if you pay yourself a dividend. For example, if you have children and want to take advantage of childcare expenses, you will not be able to do so with a dividend because you'll need to earn a salary to be able to take advantage of that personal tax deduction. Similarly, if you want to take advantage of RSP deduction, you will need to earn like employment income, so a salary. If you do want to take advantage of these personal tax deduction, then paying yourself a dividend might not be the best option for you. However, this is something that you can work with your accountant on deciding what type of remuneration is more beneficial for you. You don't always have to pick one option over the other. You can choose to do a mix of both options. So lots of flexibility on how you can be remunerated and still take advantage of these personal tax deductions. Next slide. So as you may have heard, incorporation may also provide some income tax and income splitting opportunities. This was one of the main advantage of incorporation until 2018 when finance had introduced the new rules known as TOSI, tax on split income. These rules are quite complex, so I won't go into their technicality, but essentially it imposed some limitation on who you can split income with. In summary, now to be able to income split with your spouse or adult, you are only able to income split with your spouse or an adult child if they are actively involved in the business, which usually means they have to spend an average of at least 20 hours weekly working in the business to be able to benefit from income splitting. That being said, each person's situation is different, and it is important that you should discuss this with your tax advisor on how to structure your PREC and if you can take advantage of income splitting. Next slide. Another opportunity is that the PREC brings to the table with respect to incorporation is retirement planning. As mentioned in earlier slides, incorporation allows for income deferral, but once the funds are withdrawn from the corporation, you'll still have to pay the taxes. So proper planning can be done so that the funds are withdrawn during the retirement years when you're likely to be earning less income and your marginal tax rate are lower. Next. Finally, incorporation also allows for opportunities with respect to estate and succession planning. Typically on death, the taxpayer is deemed to have disposed of any property which includes shares of private corporation at fair market value, triggering capital gains which could result in significant taxes to your estate. By setting up an appropriate share structure, there's an opportunity to lock in the value of the corporation, but allowing any future growth to accrue to the next generation, hence minimizing the tax liability on that. Again, this is something you should discuss with the tax advisor on the onset to see if this is something that you can benefit from when incorporating. So this wrap up essentially the section on the legislation overview as well as the benefits with incorporation. I'm going to now pass it on to John, who will now go over some tips and traps when it comes to structuring your real estate investment. John?
Thanks, Vanita. So if we could just go to the next slide. So now that you've set up your PREC, you've paid a lower level of tax than you would otherwise personally, and you have all this excess cash, and now you're thinking, I want to invest in real estate or something else. What can I do? How can I structure it? And what are some of the tax rates that would apply? So on this chart, what we tried to do was just simplify the rate of tax that you would otherwise pay on different types of income. So on the left side, on the column labeled flipping business income, assuming in the PREC or in another holding company, we'll get to whether that's allowed, you're buying and flipping real estate or residential property, for example. On the first $500,000, similar to the PREC income, the tax rate is 12.2%. So you should take in mind that that's a cumulative number. So the rate of tax you're paying on your commission income plus property flipping, the full 500,000 would be included in there, and the tax rate would be 12.2%. If your income is above 500,000, the rate of tax would be around 26.5%. And then if you took the money out of your PREC and paid it to you personally, the combined personal and corporate tax that you would otherwise would pay is between 54 and 55%. So there's the magic through the incorporation. The benefit is the income tax deferral that you would gain by keeping the money in your corporation, investing it, paying low rate tax, and then waiting for your retirement years potentially to pay out the cash to fund your retirement. The middle column is with reference to capital gains. So let's assume that you buy your PREC or your holding company buys a rental property, and you hold on to the rental property, you earn some rental income, and then you get some unsolicited offer, and you sell the rental property. The rate of tax in the corporation is 25%, so it doesn't matter what the gain is. It could be less than 500, more than 500. The rate of tax in the corporation is 25%. And then again, if you distributed that money out of the corporation, out of the PREC, into your hands personally, the integrated rate of tax, that's personal and corporate, would be about 29%. The last column is if, let's assume that you're not going to sell the rental property, but you're just going to continue to earn rental income. In the PREC, if you were going to earn rental income in the PREC, the rate of tax would be about 50%. That would compare to 53% if it was in your hands personally at the highest rate. And then again, integrated rate, if you flow the funds, is 57 to 58. So you can see how the benefit of at the lower levels, paying tax as low as 12.2%, and the magic behind capital gains, because capital gains are taxed very favorably in our current environment. So let's go to the next slide. So when you are disposing of real estate, there's a number of factors that the CRA has developed based on case law as to whether that income is going to be taxed as a capital gain. And as you saw, that the rate of tax is more favorable versus a regular business gain, where the rate of tax on an integrated basis is much higher. So there's 5 factors that are listed there. They are typically looked at in unison. There's not one factor that trumps the other. So some of the things that the CRA would look at is the nature of the property. Did you buy raw land or did you buy an established commercial or residential property? The length of time, a period of ownership. So did you sell it immediately after buying? Did you sell it even before it closed? Did you have it for a number of years before you sold it? The frequency and number of the transactions. Have you done this once or do you do it every year? The amount of work that you've put into the project, and very important, the last one there is your motive and intent. So what was your intent at the time that you purchased the real estate? Was it to buy and hold, or was it to be speculative and to look at a sale transaction, to make a quick buck? So let's go to the next slide. So now that we understand the tax rates, we understand the deferral opportunity. I'm going to go through some tips and traps. So as Vanita hinted, all of the equity shares, now equity shares are defined as voting shares. So all of the equity shares have to be owned by the controlling individual. So in this particular situation, even though the PREC has been set up, it's earning commission income. Let's say it's using excess cash to buy real estate, to buy a rental property. Given that the equity shares are owned by both the controlling individual and the family members in this chart, that would be a no-no, and that's contrary to the legislation. So let's go to the next slide. So one of the tips here is to segregate the voting and the non-voting shares, but also in addition to make sure that you're thinking about income splitting, you're thinking about how advantageous you can set up your structure. So in this particular situation, Justin, who we learned about earlier, is the realtor. He owns all the voting shares of the PREC, and a holding company that is owned by family members holds the non-voting shares. So in this particular example, dividends can be paid up to the holdco. The holdco can invest that. They don't have to be paid up. The PREC can invest in real estate. But there are some advantages. So for instance, when we talk about how investment income can grind your small business deduction, I'll share a little bit more in some of the later slides, how setting up a holding company may be beneficial. Let's go to the next slide. So in this particular slide, we put another holding company, in between the PREC and Justin. Again, not a requirement, but there are certain advantages that may be gained. Creditor proofing. You may want to keep the PRIC pure, meaning the only thing it's earning is commission, so that you don't have to purify it once it's sold. Benita gave some examples of how you can get the capital gain exemption, and in order to qualify for the capital gain exemption, there's certain requirements that need to be held. So having excess cash in the PRIC or having a rental property in the PRIC would depending on what the value of that is, could put you offside in terms of claiming the capital gain exemption. So what we try to do here is move the assets that would compromise an ability to sell those shares into separate holding companies. Let's go to the next slide. So we talked about the small business deduction, and we talk about the first $500,000 of income being taxed at as low as a 12.2% rate. In this particular example, a bit of a tip. Let's say the PRIC has some cash, or the individual Justin does, and he wants to enter into a trading transaction where an entity or a related party gets into an agreement with a related party to actually buy real estate in what I call the flipco's name and then sell it. By structuring the transaction so that a third party and Justin have as close as possible to a 50-50 relationship, both entities get access to the small business deduction. You'll actually have two small business deduction here as opposed to one. Let's go to the next slide. So you may say, well, I don't really trust anybody else other than my spouse. So it has to be my spouse. You still can do it by investing in an entity with your spouse, but you have to watch the ownership. If Justin in this case has greater than 25% or more ownership in the spouse's company, then they would share the small business deduction. So they wouldn't get one each. They would actually get let's say $250 each, or they can allocate as they prefer, but not to exceed the $500,000. Again, the benefit of the $500,000 is you get it taxed at the low 12.2% rate. Let's go to the next slide. So in this particular example, we had some examples about having some excess cash and investing in rental property. So, and let's assume that the rental property is being leased and that the tenant is paying, and that you're earning X dollars per month in rental income. So for tax purposes, that rental income is classified as what we call passive income, just like interest would be. And what passive income does in a corporation is it grinds the amount of small business deduction that you otherwise have. So in this particular situation, because the third party has a 51% interest, and then the rental property is being bought in this buy and hold co, there is no grind because they're not these two entities are not related because a third party controls the buy and hold co, and of course Justin controls his PRIC. So there is no grind on the small business deduction. So the PRIC would still enjoy the full $500,000 of eligibility to be taxed at the 12.2% rate. And just for your information, the grind starts to happen when you earn rental income of $50,000 or more, and if the rental income goes up to $150,000, the full small business deduction is eliminated, and then you pay tax at the 26% rate. But as I said earlier, in this particular structure, there is no grind because of the arm's length relationship between the two entities. Let's go to the next slide. So the inverse here, if Justin held 51% versus the third party, now you have Justin controlling his PRIC as well as controlling the other entity that's investing in a rental property. And now they're all related because Justin controls both. And now that the grind happens on the $500,000 small business deduction. Let's go to the next slide. So in this particular situation, again, what we're trying to do is multiply the small business deduction. The more small business deductions we can get, so the more access to the 500,000, we can get up to, in this situation, if we're eligible for 3 small business deductions, you would get $1.5 million taxed at 12.2%. In this situation, husband and wife, the husband owns the shares of his PRIC, the spouse may be owning another entity, and they invest in a company that's going to buy and flip real estate. So let's say Flipco buys residential property in its own name and holds it for a month or two and then flips it for a gain. Because of the related party situation here, the likelihood is you'd only get 1 versus 3 small business deductions. The next slide. So exact same scenario, but again, if you have a third party that you're willing to invest in, you may be able to get 3 here. There's some complicated rules about the 50-50 relationship and whether Justin is acting in concert with this third party. But the more independent they are, you'll be able to justify potentially getting, in this scenario, 3 small business deductions as opposed to 1. So you can see, and I know there's a lot of complications, and it may seem a little bit complicated in terms of how do I set this up? How do I do this? I mean, the easy thing to do is just call your lawyer and say, "Oh, I heard the PRIC legislation is enacted. I just need a company. Please set it up." I would recommend talking to somebody to make sure that what you're investing in and how you're structuring yourself is appropriate in your circumstance. Because just like buying a real estate property, you wouldn't just buy any real estate property. You would evaluate the economics of buying a real estate property. So why wouldn't you do that with what you're earning and your livelihood and setting yourself up for success? Let's go to the next slide. So how can we help? We can help by advising you how to set up your PRIC. Who should own which shares? Which family members should be involved? Which ones can be involved? Which ones can't be involved? If you decide to set up a PRIC, you'll need to transfer your existing business that you have in your own personal name into the PRIC. So you'd have to transfer the assets that you own, car, equipment, things that you own into the corporation. We would do that all on a tax-deferred basis. A lawyer would need to be involved to do the paperwork to transfer it. We would have to file a document with the CRA outlining the transfer so that it's on file. We file the necessary HST and GST forms to make sure everything is tax deferred, that you're not triggering any gains or anything like that. You may need a valuation depending how complicated your setup is of what your assets are worth. And as I said earlier, when we're setting up your professional corporation, we would give instructions to the lawyer as to how to incorporate. Which person should own shares, how many, what's the appropriate percentages, should there be holding companies, all that type of thing. So next slide. Now you're past the first year or the first 6 months or whatever it is, and you're earning income, and now you have to maintain your PRIC, right? So what does that mean? So a PRIC is an independent entity. It has to file a tax return. It has to compile financial statements. Just that like you would do individually, the PRIC has to file. If there's any wages or dividends being paid, so you have to prepare the applicable T4 slips, the T5 slips. You want to make sure that all the bookkeeping is in order, and to the extent there's the availability to simplify your life and put your books and records in the cloud and have someone have data at your fingertips. That's something else that we can help with as well. Next slide. So as I mentioned earlier, tax planning. Should you be paying wages or dividends to your spouse or your children? How do we structure your investments with the cash that you're going to be having in your PRIC? Making sure you qualify for the capital gain exemption in case you want to sell. Structuring buy versus sell of the real estate, and making sure from an estate perspective that you're properly set up. So that's a very high level view of the structuring and planning considerations. I'm going to pass it to Mickey, who's going to talk a little bit more about
John.
How, yeah,
John. Before we go there, I know there was a few questions that related to your presentation. I thought we kind of go through those quickly and then get to Mickey, if that's okay. Is that okay, John?
Sure. Yeah.
Yeah. What?
Yeah. Can you hear me?
Yep.
Okay. So we do have a couple questions.
Okay.
So first question is, if you have a rental income that's going into the corporation, does You need to register with RICO because it is not only commission going into the corporation.
So my understanding is no, you don't need to register. It's the PRIC itself that's going to buy the rental property. So the registration is required for anybody that is going to be trading in real estate, and by trading in real estate is acting as a broker or a realtor. So in this particular situation, you're buying a rental property and you're earning rental income.
Okay. And the second question we have right now is, can a third party be a family member / brother, etc., and still make a case for 3 small business exemptions?
So I think the question is, can you have a third party that can help with expanding the small business deduction? So third parties can't be shareholders in the PRIC itself or any of the holding companies, but they can set up a company off on their own that individual shareholders can invest in. So with proper planning, yes, you can attempt to multiply the small business deduction, and it all depends on the percentage ownership that each of you has in each of the entities.
Okay, those are all my questions.
Awesome. Okay, I'm going to pass it over to Mickey and Melanie, and they're going to walk you through some of the cloud accounting implications.
Perfect. Thank you, John. And thank you everyone for joining us today. I'm excited to walk you through the rest of the presentation. We'll be talking about cloud accounting. What is it and how can it help you? So what is cloud accounting? Cloud accounting is an online platform that lets you access your business information from anywhere, anytime, and from any device. The information is safe, accessible, and at your fingertips. It is designed to make you work more efficiently and therefore saving you time to help you emphasize on your business activities versus administrative and manual tasks. As the funny picture included in the slide suggests, don't look up. You won't find your cloud there. A quick fun fact for you, it is interesting that a remote platform is referred to as the cloud because in reality, data sharing is facilitated mostly by internet cables, which interesting enough, they run at the bottom of the ocean. So technically down, not up. Anyways, just a fun fact. Let's move on to the next slide, please. So why are we talking about the cloud accounting services now? The new legislation coming into effect that John and Vanita discussed and the current market conditions have accelerated the need to reassess how you are carrying on your business activities, and why not hit the reset button now? Take these changes as an opportunity to reassess, reset, and adjust. The new legislation will give you an opportunity to take advantage of tax planning and save you tax. This new opportunity, embraced with the power of technology of cloud accounting applications, will make it easier to track your receipts and ensure your claims, you claim all your business receipts at tax time. I will be speaking to that at a later slide. With regards to the current market conditions, the most current stats indicate that the last few months have been record-setting months in residential sales, with significant increases over the last year. This is amazing, but you know what this tells me? This also tells me that you've been very busy. So time is always in short supply, and I'm sure you are looking for ways to save time and be more efficient. So the questions we ask of you, are you maximizing your tax savings? How are you using your time to keep a pulse on your business activities? Are you being reactive or proactive in your business decisions? Do you have access to updated financial information, and is it available when needed? Next slide, please. So with cloud accounting services, you have the key, a concept that is so close to you. As real estate agents and brokers, you work so hard to provide your clients with the key to their perfect house, one of their most important investment in their lifetime. Next slide, please. So you have the key to open the door to your virtual office with the cloud accounting services. As a real estate agent, you need to manage your business efficiently to track and increase sales. Because you manage a range of business activities, including sales, marketing, expense tracking, and taxes, you need to have a reliable system that helps you automate a lot of the manual processes, which will save you time. Let's talk about a few ways you can save your time and stay more organized. Let's say while on the road, you can use a mobile app to track mileage, therefore maximizing your tax savings in claiming business mileage and creating an automatic log that can be provided to CRA in case of an audit. This will eliminate the dreadful manual log. It has been shown that this can increase 46% more in deductions by tracking mileage. Another way you can stay organized is by tracking your expenses as they are incurred, such as marketing, home office expenses, entertainment, meals and entertainment, office supplies. How can you do that? It is as easy as taking a picture with the Cloud mobile app. This eliminates keeping all the receipts in a box and having to summarize them in an Excel and provide them to your accountant at year-end time. So instead of having folders of receipts, and folders are the best case scenario because we all have seen the shoeboxes coming in at year-end, you take pictures of your receipts as you incur them and they upload attached to the transactions. Yes, it is true. Tracking your receipts with an app is as easy as taking a picture with your smartphone. This allows to keep electronic copies of your receipts that will not fade away. It creates rules in your accounting software to automate the process, and it attaches to the accounting transaction to give you a clear picture of your expenses during any given month. On average, it was noted that using an app for tracking receipts finds you about $3,900 in tax savings in a year. And all this for taking pictures. Not bad. Next slide, please. The Cloud Accounting Key allows you to also unlock access to real-time reports such as monthly income and expense tracking, cash flow reports, and budgets. This will unlock new insights into your business activities. The Cloud Accounting software allows you to connect your bank and credit card to pull the transactions as they happen, which allows you to have up-to-date financial reports. The monthly reconciliations are done at a push of a button. So there is no backlog, as every month can be reconciled within 7 business days after month end. No more logging into your bank account to see what was the last transaction, or even worse, wait for the bank statement to be sent to you. The software is always up to date, and if you're diligent enough to upload your receipts in the system as they are incurred, it will give you a full picture of your monthly activities. The Cloud Accounting platform allows you to have access to a robust reporting, and these can be customized. You can track income and expenses by property, by location, by type if you wish. You can focus on your growth, see the big picture, and look at accurate and timely reports to allow you to be more proactive, keep a pulse on your business, and get the business advice that you deserve. This also allows you to have more insightful conversations with your accountant at year-end, but even more so, allow them to provide you with tax planning and business advice on an ongoing basis, since they can have remote access to the up-to-date reports throughout the year and not just at year-end. So what you end up with is all your financial details neatly organized in a database, which you can pull reports from anywhere, anytime, and from any device at a push of a button. Next slide, please. In addition, with this key, you also lock your business information securely, thus providing you peace of mind. If you use online banking, then you already know what it's like to access a cloud platform in a safe manner. The cloud accounting softwares that we work with have been through various IT and security industry reviews. Some of the safeguards that they implement are data is protected with unique usernames and passwords and 2-factor authentication. It is also encrypted with the same process used by the major financial institutions, and data is backed up across multiple servers to minimize loss from natural disasters. Many businesses have had to pivot during this pandemic, which accelerated the need to access the information in a safe and efficient way. I will now pass it on to Melanie to go over the next slides. Thank you.
Thank you, Mickey. So as Mickey's laid out for you, cloud accounting really is a way to unlock your full potential in your business, leading to increased productivity and efficiency, allowing you to update and access those records in a mobile way, giving you secure access to the accurate information you need to make the best decisions you can as you grow this new part of your business. Cloud accounting allows you to be efficient, increase your productivity, monitor your sales and expenses, and manage your cash flow, and so increase your tax savings. Next slide, please. So what are the top 5 signs that you're ready for cloud accounting? How do you know when you're ready? In addition to the items McKean mentioned in terms of reacting to our current pandemic situation where remote and mobile access is even more important than before, and current market conditions, if you've ever asked yourself any of the following questions, you might consider that it's time to look at cloud accounting. Some of these questions might be, or statements might be, that I'm just spending too much time on manual tasks. How can I be more efficient with my time? Or if you dread tax season, why am I still using Excel to track all of my transactions? Where can I get good business advice? Are my records showing me accurate information about my business to really rely on for that advice? How can I better manage my cash flow? How do I maximize my tax savings? How can I get information? How can I get access to my information remotely and securely from anytime, anywhere, so I have an idea of what's going on in my business? And do you have a hard time, or do I have a hard time making informed decisions about the opportunities in front of me as I progress in my business? If any of those questions come to your mind or sound familiar, it might be time to look at an option like cloud accounting as a solution for your business. Next slide. And if you've decided that it's time to have a conversation, where would you start? You would start that conversation with a Grant Thornton Cloud Advisor. We can help you we better understand your needs and the challenges that you're currently facing in your business. Opening a PREC is also a great time to have that conversation so that you start your corporate records out on the right foot from the get-go, and you don't have to go back later and try and sort through and get yourself set up. Together in conversation, we look at your pain points, what your workflow looks like, and we would build a customized ecosystem of existing cloud applications that would integrate with each other to automate the flow and accessibility of your information. Our services are customized so that we meet your unique needs. Our trained cloud technicians can assist with setup, and they can train you to do the monthly transactions on your own, with our team standing by should you ever run into trouble. Or once the setup is complete, we can provide those monthly services for you and business advice as you need it. That's our summary about cloud accounting. John, I'll pass it back to you for a summary and any questions.
Yes, so thanks everybody for listening in today. It's time for questions. So if you have any questions, feel free to forward them along and we'll try and answer them the best we can.
Okay, so we have some questions. Okay, just give me 1 second here. All right, so we have one that's an agent asking that you're near retirement and own multiple rental properties. Would I be able to include these already owned properties in my PREC and commissions already earned in my PREC, or just new income?
So if you own the rental properties personally and are planning to move them into the PREC, there's a couple of things that you should be wary of. One is in order to do this on a tax deferred basis, you want to make sure you minimize land transfer tax. So by transferring the real estate personally into the PREC, there's likely a land transfer tax obligation that would be held. Could you do that? Yes, I don't see any reason why you couldn't transfer it. If you are in the top marginal bracket, any rental income that you're earning personally would be taxable at a 53% rate. You would get some creditor protection, I think, in the PREC, or if you put it into a holdco more specifically, that may be potentially owned by different family members. We can look at that. But in corporate form, there's a little bit of a deferral. The tax rate on the rental income would be about 50%, so a 3% deferral. But again, if you took that money out, then the integrated rate seems to suggest that holding personally would be more effective. So hopefully that answers your question.
And so just to kind of piggyback on that one is, if an agent who has an already existing incorporation that's registered before October 1st, before the PREC is established, can they use this incorporation to start with it, to put in any deals that have been written before October 1st?
So this was a common question, and I think the question was even raised at the OREA presentation. So I know there's still guidance that's going to be forwarded, but generally, what the CRA would look at is where or at what capacity did the individual earn the commission. So if the deal was entered into prior to setting up the corporation. Then and the individual themselves did all the things that they needed to do to earn that income, the CRA may argue that you're earning that in your personal capacity. If you've set up a corporation already and are looking to include that in the corporate earnings, that transaction or that listing or that income should have been moved into the company at some point. So I know it's not a perfect answer, but we really need to look at the dynamics between, who earned the commission and whether the availability to transfer into the corporation is an option. Because, you could take the position that that you acted on behalf of the corporation, but the CRA may not agree with you.
Okay. What are some of the approximate costs to establishing a PREC?
Okay, so I can give you an indication of the accounting and tax advisory costs. So the first thing that needs to happen if you are going to set up a professional real estate corporation is you have to incorporate. You have to get the entity set up. So that your lawyer can help you with our assistance in terms of how you want to structure it. So that physical transfer of your business into the PREC, so doing the moving of your assets into the PREC on a tax deferred basis, doing the GST, HST fine, making sure that no tax is triggered, and providing guidance to the lawyer to set up the actual PREC. That fee is in and around $2,000 to $3,000. Now, subsequent to that, now you're going to be operating in the PREC, right? You're going to be earning your commission income in the PREC. You're going to have all this income. You're going to have all these expenses. So the PREC itself has to have should compile a financial statement so you know how profitable hopefully the PREC is, and it also has to file a tax return at the end of each year. And that range the combination of the accounting and filing of the tax return, I would say the range for that anywhere between $2,500 to $5,000.
Okay. So another extension of that is, what's the best way to run expenses through the corporation that are usually paid by Escarpment and charged back to the agent on a monthly statement?
So I don't see any difference, in terms of the way it was done in the past versus how you would, do it currently. The corporation, the actual realtor broker is performing services on behalf of the corporation. So charging back those fees from the escarpment to the corporation, would be similar to the way you did in the past. I assume that, to make sure that there's proper documentation, that potentially, there's an invoicing system potentially that charges back to each corporation, so that if the CRA ever asked, what are the services for, there's proper documentation in order to support the expenses being claimed.
Okay.
Yeah, I want to step in with the costs with regards to the from the lawyer standpoint. Our partners at Escarpment Law have fielded several emails, and I know Alana is also, I think she's watching this as we speak. Normally they would charge like $900 plus HST to set up the corporation, but they have reduced it to $595 plus HST plus $600 of disbursements, which would cover filing fees, minute book, corporate seal, etc. And they should expect a bill for about $1195 plus HST. So again, our partners at Escarpment Law have graciously giving their services to set up these corporations, and we'll work hand in hand with Grant Thornton or any of the accountants you decide to go with. So anyway, just want to throw that out there. Okay.
Thanks, Conrad. Appreciate it.
Just a few more questions. If both husband and wife are registrants, what are the benefits of both incorporating, or would it be advantageous only for one to be incorporated?
So the way I would answer that is on the assumption that both husband and wife are high income earners. So let's assume they both earn in excess of the top rate of $220,000. Then it would make sense for each of them to incorporate, especially if they don't need all the money to spend personally. because any income over $220,000 would be taxed at 53% if they left it in their personal names versus, in the corporation. They each have to have separate corporations, by the way. They would enjoy the benefit of two small business deductions. So husband could earn 500,000 and pay 12.2%. Wife could pay 200,000 and pay 12.2%. Now, if, I think Vanita hinted on this earlier, if each of them are big spenders and basically spend all the money that they earn, then incorporation wouldn't make sense because you're not getting the deferral. You're not keeping money in the company and investing or doing whatever you think is appropriate with the funds.
Okay. Can a registrant wife be paid as an employee through the corporation?
So generally, each PRIC needs the voting shares have to be owned by the salesperson or broker, and that individual needs to be employed by the brokerage. So if a wife is a registered agent, she can be an employee, or let's turn this around. If the wife is the realtor and the husband wants to be paid a wage, he can be employed in the company and earn wages, but will not be allowed to trade in real estate or earn fees from the brokerage in that entity. The individual, if they're planning to trade in real estate as a realtor, would have to set up a separate PRIC, and that PRIC would earn the fees from the broker.
Okay. Can a licensed assistant be paid by the corporation as an employee? If not, what would be the best route to run expenses? Escarpment continues to pay the staff and then invoice the corporation.
Yeah, so similar to the answer, so anybody can be an employee of the corporation. They can't just, but the only restriction is only one person can trade in real estate. So the licensed administrator can be employed, earn a wage for services, but cannot be a realtor and earn commissions or salary, from the brokerage. So if there's an alternative that the administrator work for the brokerage and then charge back to each of the PRICs, then that can be done as well by invoicing. But the licensed realtor cannot earn commission income into that entity. They have to set up a new entity. So you can have more than one registered agent earn fees in the entity. So that's why, for instance, team members have to set up their own PRICs. They can't all be registrants earning fees in one PRIC.
Okay. Is there a minimum level of income that makes sense to set up the corporation?
Again, I would say minimally you need to be in the top bracket, so anything above 220,000, and then the decision comes to basically a math scenario where you look at the spending, how much money the individual plans to take out of the company, if they're planning to leave it all in. And the reason why I say 220 is because earning the income personally, you get the benefit from the marginal tax rates. So when you're in that upper echelon of earnings, then I would start thinking about, whether it makes sense to incorporate. But every fact pattern is different, right? Because you may be over and above 220, but need all the income to survive. Others may be above 220 and don't take any of the income out, right? So.
Mm-hmm. Okay, and then there's several questions. Agents are asking, what's the difference between your cloud accounting and something like QuickBooks?
Absolutely, I'll take that. QuickBooks is actually one of the softwares that we use within the cloud accounting services. So QuickBooks Online is we use that as the core application, or there's various ones, that being one of them, but it also has its limitations. So depending on everybody's needs and the individual's needs and what they're trying to accomplish, there's over 800 applications out there. Not that we're experts in all 800s or we want to be experts in all the 800s, but there's different applications that they're designed to do. For example, for receipts, the OCR technology in the QuickBooks Online is limited. So therefore, we look at different applications that's what they do. They take the OCR technology and they automate the transactions. So we look to create different ecosystem that it's customized based on everybody, like on that individual's needs. So QuickBooks Online is just a part or one of the softwares that we use. Mileage, for example. So again, QuickBooks Online, it does have the mileage feature. However, it has some limitations. Therefore, we look at different applications that connect with QuickBooks Online to create an integrated system.
Okay. Those are all the questions we have. Conrad, do you have any questions?
Yeah, I do. My video starting. So John, we've set up very successfully sub brokerages. So these are, let's say, teams, large scale teams, and very highly productive individuals decided to set up a brokerage, a sub brokerage of ours. So they have their trust accounts and all that kind of stuff. Very similar. It's a microcosm of what we have. Does it make sense for them, those people that own those brokerages, to set up prereqs? You know, if there's a husband and wife involved, or even for themselves, does that make sense? And then they can then take advantage of that small business deduction or small business tax rate in their prereq. Yeah,
so it's a very good question. I mean, the realtors that have set up under the sub brokerage structure, they need to be registered, right, as brokerages, those incorporated agents. That's so right. unlike the PREC, where you don't need to be registered. So, you know, if I was a realtor, I would evaluate, you know, some of the fees, things that need to be paid, in comparison to the PREC structure, where the legal and accounting fees that need to be paid, the external ones, are the same on both sides. So depends on the appetite, the value that's bringing, the brand value. The benefit of the sub brokerage structure, the incorporated agent, is they don't have the restrictions on the shareholdings, right? So you can have you know, any number of individuals, you know, as shareholders. You know, like we went through the presentation, there's some restrictions on who the shareholders can be. So every person's you know, status, you know, they would need to evaluate, you know, fees, administration, that type of thing, versus, you know, perhaps more simplicity and not being needed to register with the PREC, and also the fact that you know, the sub brokerage structure allows for multiple shareholdings, including trust with children and things like that. You know, they could be minors, they could be you know, any number of different beneficiaries, where there's some restrictions on what the PREC offers. So the PREC offers an opportunity for those that you know, maybe haven't incorporated yet, that want to benefit from the income tax deferral. The sub brokerage structure, the individuals presumably have already benefiting from that structure, and just a matter of which avenue they want to continue in.
Yeah, because I was looking at it from going from the larger scale tax rate. So if they owned their sub brokerage 50-50, let's say with their spouse, does it not make sense for them to have a PREC rather? Because I call it PREC. PREC. Like let's say they're both registrants. If they had a PREC that they owned 100% each, that then would they not? Then at that point, would they not get the small business small business deduction in their PREC?
Yeah.
And then
because
sure. let's say their brokerage has an excess of $1 million.
Yeah.
Okay. They're charged at that higher tax rate. They can pull $500,000 at least out.
Yeah.
$250 a piece in their PREC and be only subject to the 12.2 rather, right?
Yeah. So you're absolutely right. The advantages of everyone having a separate PREC is that you can multiply the availability for the small business deduction.
Yeah. Okay. That's all I wanted to get clear. Okay.
Yeah.
Thanks.
Yeah.
Okay.
I just have a few more questions that just came in while you guys were talking. We have some time still?
Yeah.
Yeah. Okay, good. All right. So one is, do you need a separate bank account?
So I would say the answer to that is yes.
Okay. And can a husband and wife team own the PREC jointly?
So the husband and wife can be shareholders of the PREC, but the type of shares that they own would need to be different. There's only one shareholder, so if they're both registrants, only one can own the equity shares. The other one would have to own the non-equity shares. So the equity shares are voting, and the non-equity shares are non-voting. So could they be involved? Yes, but only one of them can own the voting shares, and only one of them can earn commission income in the PREC.
Okay. In regards to cash extraction, how does CRA perceive a non-interest bearing holder loan to the voting shareholder PREC owner? Is there a time limit for that to sit in the balance sheet?
So I think what this question is getting to is, where a shareholder pulls out cash and has to repay the corporation, and if the shareholder doesn't repay the corporation, they're subject to the taxation. So typically, the rules around pulling out shareholder loans is that loan needs to be repaid within 1 year after the end of the year in which the loan arose. So if we go backwards, so this is probably attributable to non-PRECs because PRECs have just been legislated. But if a shareholder, took a loan out of a corporation and that had a December 31st, 2019 year end, that loan should be repaid before December 31st, 2020, or otherwise the full amount of the loan would go into the individual's personal income. The first part of the question about cash extraction, so there are ways to mitigate that income inclusion. So before in my example, before the December 31st, 2020 timeframe, there are ways to take out cash more effectively, so you're not paying 53% on the funds, or alternatively, if you choose to settle that loan with a dividend, paying between 39 and 47% in Ontario. There are ways to reduce the amount of taxation to as low as 25 or 26%. It's a very interesting question because we do this a lot of planning around taking out cash on a tax efficient basis. So.
Okay, and then just a little bit more clarification. So if an agent has an existing incorporation already and they have pending deals that they haven't been paid on, but they were written before October 1st, can they get paid through the PREC versus?
Yeah, I know. I hate to be vague on this, but I mean, this is one of the fundamental issues that AREA is looking at. And it's subject to, of course, what the legal ramifications are of when that income was earned and who had earned it. So I would look to some guidance coming up because I know that if you go to the AREA website, there's a very specific question on that, and they provide some guidance on some clarification, hopefully very, very shortly.
What would the worst case scenario be?
In terms of earning that income personally. The worst scenario would be, if I'm trying to think about this, let's assume that you chose to record that income in the corporation, pay tax in the corporation at the small business rate. The CRA came back and said, nope, you didn't earn that income in the capacity as an agent with reference to the PREC or the corporation. It's actually personal income. So you would have to pay tax at the personal rate, plus interest and penalties for not remitting the amount of tax, the right amount of tax when you filed your tax return personally.
Okay. And then just one last one. We have a few questions regarding if you guys can share what some of the costs are to using your cloud online accounting.
Yes, I can take that one. Thank you. So it really depends in terms of the cost. It really depends on how involved you'd like us to be. So our services are basically customized based on the needs of the individual agent. So usually there's a setup fee. So that would imply looking at the needs and assessing what are the different applications that would benefit. And we would set up and do the training. Also, we could be doing the monthly bookkeeping on an ongoing basis, and that depends on the number of transactions on a monthly basis, number of accounts. So there's different variables that would drive the price. But what we do is we do on one-on-one, we call it a discovery. So where we spend about an hour, in terms, half an hour to an hour, in terms of going over the workflow and understanding what the pain points are, what the needs are, and we really try to customize the service and using the different applications to put something together in terms of a platform that would best fit, and the price would be dependent on that. But there is a setup fee and then training, and then it really depends if you want us to be involved in the monthly bookkeeping and advisory part of it, or you just want us to provide advice on a need basis. So for
Nikki,
that,
could
I
you
would
give us
recommend. Sorry, I would recommend for that, like, definitely, it's such a case by case situation. Please, if you have any questions, don't hesitate to contact us, and we'll be more than happy to have a call and give you specific scenarios and pricing within that.
Could you give us just a range, just so that they have an idea?
Yeah, absolutely. So for example, the setup. So if we look at a basic setup for the applications, it could be anywhere from $750 to $1,500, and that includes the training and 30-day service, basically, where we provide we basically provide all the support. And then for the ongoing bookkeeping, like I said, it really depends on the monthly transactions, level of transactions, but it could be anywhere from 400 to 1,000. It really depends on the type of service. Like I said, we can be as involved as you like us to be. So depending what you want, do you want the advisory? Do you want the bookkeeping? So it really depends on that.
Okay, thank you.
No problem.
Those are all of our questions.
I just wanted to thank the panel, everybody. Again, really put this together in short, in a very short term. I want to thank Mickey and Vanita and John for all the advice. And I want to talk about Melanie, who's she's a partner, and she's somebody I deal with, like, extremely accessible all the time. We have a history with, not with Grant Thornton as much, but with Grant Thornton acquired our accounting firm. We're going on, Melanie, I think it's like 50 years. Can you believe it?
Yeah.
We've been with this accounting firm, or a reiteration of it, or a prior reiteration of this accounting firm, for 50 years. One of the most accessible, down-to-earth, easygoing group to deal with, and a lot of specialists in different areas. So you can imagine they've been a resource for us for several years. I can't speak highly enough about that organization, and Melanie and Paul Gibble and the whole group in terms of being able to help us out throughout these 5 decades, and 5 decades of audits, and we came out shining. As a matter of fact, one audit, I remember correctly, that CRA owed us money. It was so awesome. It was an interest tax calculation, but anyway, they found out that they owed us money, and we had over contributed on a small thing. So all I can say is this: at the end of the day, these are the types of things that peace of mind means so much, and having the right people in your corner is so critical. This is a huge benefit for us as an industry. There's some huge savings, but again, it all depends how you set it up. So at the very, very beginning, because you don't want to, it's like a foundation of a home. You want to make sure that foundation is correct, and to give yourself those options down the road as your income starts to grow, and you want to do that much more with your prec and with your holdcos and things like that. This is truly a wealth builder. So I think it's really critical to have that kind of team around you to help you build wealth. And again, I want to thank everybody who came out and partook in this webinar. Again, all of you investing time and energy in your businesses. It's a great thing. Fabulous for the industry. We are, the strides we're going to take with this type of tax savings is going to be monumental to build your family's wealth. And that's what it's all about at the end of the day. So again, I want to thank John, Melanie, Vanita, Mickey. I want to thank Jennifer for facilitating, Virginia, who's had her hands full like crazy because we have another event tomorrow. What kind of planning was that? But we wanted to make sure we got this in a timely fashion. And again, you have everybody's contact information. Again, my sister Joey, also who's on the line, who's helped organize this, and the team at Grant Thornton. I know your marketing team and everything was involved in this as well. Again, thank you very much. Thank you all for participating and investing in your business. And we enjoy watching your businesses grow and you create that wealth. And this is a great key to that success. Thank you, everyone.
Thanks, Conrad. I really appreciate it. Thank you.
Thank you.